summer about a narrative in which everything gets bought later in the year, in your view. But you also in August said, don't be a hero. So can we be heroes now?
I think that markets are sort of seeing this gigantic wall of worry, Carl, and I know people are talking about Evergrande and the spillover being like Lehman. But when I look at what yields are doing, which they're being quite tame, and the VIX isn't really as jumpy as it could be, I'm in the camp that this is going to prove to be a really good buying opportunity. Now, I heard Michael Santoli, and I agree with him. I don't think that means stocks find their bottom today or even tomorrow, but is the recovery that's only 1 year into over, or has the pent-up demand been exhausted because of some property woes in Asia? I would say no. So I would look at sell-offs like this, which is like sort of broad-based selling, as time to sort of add incrementally, only knowing that it may not be bottoming today.
Right. Of course, there's property in Asia. There's obviously the trajectory of the pandemic, which I know you follow closely. For others, it's about domestic policy risk and how the market absorbs the next couple of months of Washington. How do you think that happens?
Well, yeah, unfortunately, Washington is unpredictable. And, I know there's going to be a lot of headline risk. It's something Tom Block, our policy strategist, has talked about. But for investors, unless there's going to be, dramatic changes coming out of Washington, the debt ceiling and risks of a shutdown, while they're kind of scary and may cause headline problems, they don't really change where stocks will be 6 to 12 months from now. So again, I'd be sort of trying to take my lens, look a little further, and realize we're going through a lot of chop right now. But number one, I think we're going to finish strong seasonally. I mean, I think also September has a chance to really turn around. I think we're at a moment where everyone's only seeing sort of darkness and downside, and usually that's when you want to be adding risk.
Well, so Tom, tell us a little bit about that long-term bull thesis and how millennials and your expectation for how millennials are going to be spending plays into that.
Yeah, I mean, I think one thing that we have to keep in mind is I don't think there's enough of a focus on sort of demographic tailwinds that are being generated by millennials. And I think the first and foremost is, it's people aged 30 to 50 that really drive economic growth. It's so apparent looking at Chase credit card data or any of the credit card data numbers. And this number of people 30 to 50 is actually starting to accelerate because of millennials. And on top of that, U.S. household wealth now has hit 120 trillion, which is a staggering wealth level. But about 2 trillion of that is being inherited per year by millennials. And so over the next 20 years, millennials will inherit collectively something close to 70 trillion. So you have a sort of a 10, 20-year window where millennials are not only contributing to a revitalization of economic growth, but then their wealth is growing very quickly too. And that's a great combination for risk assets, especially stocks and crypto, because millennials generally are sort of buying disruptors, really into decentralized finance, and less interested in bonds. This is all great news for stocks.
It is, but are there any risk factors that you're watching, either whether it's about consumer confidence or other issues that could make those millennials less of a growth driver than what you're anticipating?
I mean, plenty can go wrong. I think the biggest risk is something that would cause the Fed to have to really take aggressive measures, and that would be inflation rising at levels that are uncomfortable. I just don't know what that level is. I don't think 2% or 3% is sort of the kind of inflation that scares people. And then, of course, the second would be some sort of exogenous shock. Now, that could be a commodity shock, like if oil gets to 200. Although 200 today is not really the same as 200 in 2008, or some geopolitical event. So, I mean, I think there are plenty of risks out there, and I don't think stocks are invulnerable, so they can always decline dramatically. But I think that the sort of structural tailwinds are in place for the S&P to rise for quite a long time.
Tom, what are you learning from the way investors are responding to risk, particularly when it comes to riskier assets. You mentioned crypto, which I know you've had a lot of thoughts about, and you have a big following in. Bitcoin, Ethereum down big today, along with some of the growth names that we track, particularly in tech. What does that mean as far as what people might move out of and into, or maybe not be able to move into anything if we hit a patch of declines like this?
Well, I think one of the changes I've seen since the start of this COVID era is investors really value liquidity, 24-hour liquidity, meaning I'm finding both institutions and individuals more willing to go to cash because there's less friction in terms of liquidating. Bitcoin selling off to me is interesting because I suspect it has a lot to do with risk off in Asia. As you know, in Asia, savers really put their money into property and into crypto much more than they do with equity. So I think on days where someone who might be long a lot of property in Asia, they might be worried about, impaired value, and I think they're raising cash. So I don't think Bitcoin's decline today is actually very ominous, but it is sort of showing you that people really value liquidity.
Hey, finally, Tom, you've coined a class of stocks which you like to call granny shots, meaning it's an easy basket given the background environment. What kinds of names are still in that basket? Is this an area where, when you do decide it's time to make a bet, that it's going to be on epicenter, cyclical materials, that kind of thing?
Yeah, Carl, I think that when someone's constructing what they want to own, I think a big chunk has to be compound earners, companies that can, in an all-weather basis, generate better than GDP top-line growth, and because they have great value capture, can grow earnings much faster. And names like NVIDIA, Tesla, I mean, these are all structural, compound earners. So I like those. But when I look at the fact that the virus in the U.S. is really diminishing, and that there's a lot of pent-up demand, that really is a tailwind for cyclicals. And I think a great clue is looking at oil, which is holding at 71. And I was just looking at this morning, when I look at CapEx to sales, for instance, for the energy sector, it's at near 20-year lows. So, I mean, that's an industry that's generating just significant cash return for shareholders, and it's not reflecting the stock. So I still like epicenter into year-end as well.
Tom, great way to begin the hour with you as well. Our thanks. We'll talk to you soon. Tom Lee.
Thanks.